morning and welcome to our Basel 3.1 webinar. My name is Hussein Shaheen, Banking Asset and Wealth Management Consulting Lead for Forvis Mazars UK, and I have the pleasure of being joined by our prudential experts in India and Freddie. I think a number of you will be familiar with India Freddie from prior Basel 3.1 webinars and our recent SDDT webinar last week. The recording for that is still available on the Forvis Mazars website. Both India and Freddie joined Forvis Mazars from the Bank of England a few years ago, and I always look forward to hearing their thoughtful insights on matters prudential. This month, the PRA finally published the second and last instalment of the Basel 3.1 rules, mainly covering the near-final rules on credit risk disclosures and reporting. This policy publication is part of the post-crisis reforms designed to improve the resilience of international banks. As many of you know, many of the standards have already been implemented in the UK, increasing the quantity and quality of capital. In particular, the parts of Basel III that remain to be implemented focus on the calculation of risk-weighted assets. These mainly focus on improving risk sensitivity, particularly in the standardized approach, and reducing excessive variability in the modeling approaches. There's also an introduction of the output floor to backstop model risk weights. This webinar is number 1 of 2. We'll be hosting our second webinar next week, and we'll give you more insights into that upcoming session at the end of this discussion. We are live on LinkedIn, and this session is being recorded. Please do keep your questions coming through the chat on Zoom or through LinkedIn comments, and we'll get to those at the end. So to set the scene, you'll recall that the consultation paper covering credit risk and the output flow was published in November 2022. At the time, there was a lot of focus on a number of potentially controversial proposals. This included the removal of the SME discount factor, and there's still some uncertainty, we believe, within the industry about how the PRA will adjust for this in Pillar 2, and more on that later. Changes in the valuation for real estate exposures, changes within some details around internal models, and as I mentioned earlier, the output floor itself. We hope that after today's webinar, you'll walk away with an understanding of 2 things in particular: the key changes between the consultation period and PS 924, and how this may impact your firm. Having set the scene, I'll turn to Freddie to get stuck into the first of our specific areas, the famous SME discount factor. Freddie, lots of interesting gossip around this leading up to the publication. This still continues. Where has the PRA landed on this?
Thank you, Hussein, and good morning, everyone. So yes, as Hussein said, the PRA, they've made some substantial changes to its SME proposals in this near final rules. And I think it's fair to say that by and large, they've responded to industry feedback on the topic. So just to give you an overview of what the big headlines are, one, we've got the fact that the PRA, they're still removing the SME discount factor. And so what this means is that there's going to be an introduction of a new 85% preferential risk weight for exposures to unrated corporate SMEs. You're going to have retention of an existing 75% risk weight for exposures to qualifying retail SMEs. And you've also got the introduction of a new risk weight for retail SME transactor exposures. So that's the sort of big headline: removal of the SME discount factor. But while the PRA are removing the SME discount factor, they've also stated their intention to neutralise any capital uplift that this will have via the introduction of this firm-specific structural adjustment, a lovely long regulatory phrase there, to Pillar 2A, which is basically going to be called the SME lending adjustment. And I'm going to have a bit more detail on that and the outstanding questions relating to that a little bit later on. It is worth noting that in the original PRA proposals from the consultation stage, we here at Forvis Mazars calculated that these could result in a 3.5% increase in risk-weighted assets for the most affected firms, and that's their overall risk-weighted assets. And that, if you take the PRA's word for it, is going to be neutralised under the final standards. Just to say, like the SME discount factor, the infrastructure supporting factor, that's also being removed. But again, to offset this, the PRA, they're going to introduce a firm-specific Pillar 2A structural adjustment to try and again ensure that overall capital requirements are not increased between the 2 regimes. And so as part of all of this, the PRA, they're going to invite banks and building societies to take part in an off-cycle re-evaluation of their Pillar 2 capital requirements. And the assumption there is that is going to take place at some point next year ahead of the implementation of Basel 3.1 on the 1st of January 2026. So those are the headlines, just to give a quick overview of what else is changing, and some pretty important changes here as well. So there's a change in the definition of actually what constitutes an SME. And so the definition now is just centered around the firm's revenue, with the threshold being a maximum of £44 million of annual turnover. And what is also changing is that the definition of an SME, it now applies at the consolidated level. And there are also some other adjustments that are being made in the proposals and differences from the consultation stage that are at a bit more of a granular level, but nonetheless quite important. So that includes removal of a 100% risk weight floor for SME exposures secured by commercial real estate. And I think this is expected, and we expect this to result in lower risk weights for certain SME exposures in particular. So just to give one example, exposures where you've got lending that's secured on an SME's own commercial premises. That type of lending, there's going to be a big positive difference, I think, between consultation and near final rules. And overall, what a number of these tweaks are saying is that it means that SMEs, they're really going to benefit from preferential risk weights under the new regime relative to non-SMEs, and in particular non-SME corporates.
Thanks, Ben. So this seems like good news for the industry, but is there still some uncertainty about how the PRA will apply the Pillar 2A adjustment?
Yeah, so like I said, that element of the proposals is that the PRA has not provided very much detail in the near final rules. So while confirmation by the PRA that the proposals are going to have a net neutral impact on capital requirements associated with SME lending, that's going to be seen as a positive. And I think overall it's probably going to be most positive for some of those non-systemic firms. Because a number of these, they may not have the largest sort of overall SME lending portfolios, but they do as a percentage of their balance sheet. So they're really exposed to these changes in underlying SME risk weights. But firms, they're still going to have to wait and see how this promised overlay adjustment, whatever you want to call it, in Pillar 2A is actually going to work. And at the moment, there's very little information. And so there are quite a few things that are not yet clear that the PRA are going to need to clarify. So just to give two examples, one, if you're going to remove the SME discount factor and you're going to leave the increase in SME risk weights in Pillar 1, that's going to have knock-on effects for the wider capital stack. So, for example, it might have a marginal increase in macroprudential buffers for most firms because those buffers are based on Pillar 1 risk weights. So that's one thing that the PRA is going to need to address. And another is it's also unclear how the PRA is going to ensure that this SME adjustment in Pillar 2A, it's going to be variable and it's going to sort of adjust over time as a firm's balance sheet changes. So yeah, still quite a few areas to keep an eye out for that the PRA is going to need to address in the coming months on that particular topic.
Thank you for that, Freddie. There are also significant changes to the classification of residential commercial mortgages. This is another aspect of the original proposals that proved pretty contentious across the industry. In India, can you provide an overview of any key changes from the consultation phase, please?
Thank you, Hussein, and good morning, everyone. There's been a lot of change on this matter between consultation and policy. So under the new rules, regulatory real estate exposure risk weights will be determined based on property type, loan-to-value ratio, and whether or not repayments are materially dependent on cash flows generated by the mortgage property. There are several changes that have been put forward in policy that will be welcomed by firms. The PRA had previously classified care homes, purpose-built student accommodations, and holiday lets as commercial real estate, and this was not very popular. In final policy, the explicit classifications around these have gone, which is good news for firms. These can all be classified as residential real estate, but only for as long as they can be resold as a standard residential dwelling in the event of repossession. Now, the good news continues here. The PRA is also going to classify self-build and second charge mortgages as regulatory residential real estate, and they will therefore be eligible for lower risk weights, barring some minor conditions being met. Finally, the PRA has previously proposed that HMOs should be treated as materially dependent on cash flows and therefore attract higher risk weights. But under the new rules, this will still apply unless they're owned by individuals that have 3 or less mortgage residential properties, in which case lower risk weights would apply. One area of uncertainty, therefore, is how firms might find out when the 3 property thresholds have been crossed by a landlord, and that's something to think about quite closely. There are also some tweaks to the risk weight classification for residential exposures that are materially dependent on cash flows by the property and attract LTVs of between 60 and 80%. We'll see their risk weights being defined to improved risk sensitivity. The PRA has also classified loans that are secured by residential and commercial real estate that they'll now need to be split into 2 parts, and both parts will attract a separate risk weight. Now, how firms update their systems to do this and how this impacts their pricing are amongst a number of areas that would need to be thought about in a bit more detail.
So just to recap, there's a lot there. We have relaxation in the definition of regulatory real estate for a number of different types of risk exposures, which will be positively received, we think. However, you also briefly mentioned this concept of a residential real estate exposure being linked to the idea it could be resold as a standard residential dwelling. What do you think that means in practice?
Yes, Hussein, so that is a gray area, and firms will have to therefore have a very clear documented policy generated internally on their approach to this. Our view is that the industry would and perhaps should follow the legal definition of the standard residential dwelling. This definition includes provision for the fact that such dwellings should be self-contained living accommodation, and what that means in practice is that the most basic elements of living, such as sleeping, washing up, preparation of food, and so on, they're located together within a defined area and not shared by more than one household or tenant. Now, firms should be mindful that in some cases, there could be planning restrictions that might prevent it from being occupied as a residential dwelling after repossession. Now, despite meeting the legal definitions, such homes with such restrictions may still not qualify as residential under Basel 3.1.
So turning briefly to valuations in India, again, looks like the PRA have been receptive to industry feedback here. Is that correct?
That's right, Hussein. Significant amendments have been made to how firms would need to carry out valuation. Overall, the final rules on revaluation of real estate, they're more risk sensitive than perhaps what we saw in consultation, and it will be far more operationally simpler to implement. In terms of the main takeaways, firms will need to revalue the property every 5 years, unless where the loan amount is more than 2.6 million or greater than 5% of the firm's own funds, in which case the revaluation should occur every 3 years. Now, there's also another point where perhaps macroeconomic conditions lead to a greater than 10% decline in property value. Again, in such cases, revaluations would need to take place on a more regular basis. The PRA has also clarified that valuations can be provided by AVMs or any other suitably robust statistical model, which wasn't explicitly the case in the consultation publication. This is largely going to be good news for firms and for major high street banks, quite reasonably, because fixed rate mortgage terms generally renew at 5 years or less, which coincides with the maximum frequency at which the PRA is asking for these revaluations to take place. As such, if you look at the additional effort that firms might need to put in terms of valuations, it could well be fairly limited under the new rules.
Thank you, India. Now, let's focus a bit on proposals relating to IRB modelled approaches. Freddie, one of the overarching goals of the Basel 3.1 proposals was to neuter, to some extent, IRB models and introduce more comparability with the standardized approach. That looks like it's still going to be the case. Is that correct?
Yeah, I'd agree with that overall assessment, but there are quite a lot of moving parts under the hood of the proposals in the near final rules, and you've got some positive news and some that's maybe more negative news for firms. So what I'll probably do is just try and discuss what I think are the key elements regarding the IRB proposals and what they mean for firms at a sort of high level. And first, I'll just cover the rules relating to IRB models approval, because I think here the near final policy proposals, they'll be regarded as being a big positive for firms. And then I might just do a quick deep dive into the rules associated with one of the critical elements of IRB models, which is around probability of default, And here I suspect firms may be less pleased with what the regulator has concluded. So if we just start with the good news, and that's around models approval. And here, I think the PRA, they've basically maintained their position from the consultation paper, and that's that IRB models, they should achieve this idea of material compliance under the final rules instead of the current need for full compliance under the current CRR when it comes to models approval. So what this essentially means is that the PRA is going to have greater flexibility going forward to approve IRB model applications. Secondly, the PRA, they're also going to allow firms to make or revise an application under the near final rules. And what this basically means is that the new and slightly more relaxed framework is in effect coming in now, rather than we're waiting for 15 months for the implementation of Basel 3.1. And this should speed up, we hope, the model approval process even before full implementation of the final Basel standards. Thirdly, the PRA, they also clarified the fact that they're going to move towards a more conditional model approval approach, and that would bring it more in line with what actually takes place at the moment in places like the EU, for example. But it is worth caveating that when it comes to something like conditional models approval, they'd still need to take place on the basis of a couple of conditions in particular, one of those being where approval of the model would reduce the overall level of non-compliance, IRB non-compliance at the firm, and the other being that the firm would have a credible remediation plan in place to bring that model up to full compliance in due course. And then finally, following feedback from firms about the operational burden essentially of building models, especially for material exposures, but that have small rollout classes. So you've got lots of different models that you're having to apply for and be assessed. The PRA has essentially revised its materiality assessment there. So it's now going to be more of a cumulative assessment across rollout classes rather than looking at individual models. And so I think, overall, what all of these proposals they're doing is they definitely represent a much more pragmatic and flexible approach than even was part of the consultation paper, and certainly what we have under the current regime. And it's fair to say that, if you take a step back, in the consultation paper, the PRA, they signaled that ambition to try and unlock what is essentially a logjam at the moment that firms are experiencing when it comes to model review and approval. But there wasn't that much substance in the underlying text to back that ambition up. But I think with these revisions, the substance is now there.
Thank you, Fred. And I suspect for a number of IRB firms, this might actually be the best news story from the entire Basel 3.1 package. Clearly, that's going to be subject to how the PRA implement the proposals when approving models. Moving on to some of the detail of the proposals, one of the areas where the PRA gold-plated the underlying Basel proposals was around input floors for residential mortgages. Has there been any changes here?
Actually, so for input floors, there actually isn't that much change from the original consultation. So I won't dwell on them too much, but just very quickly, I guess the story here is the fact that the PRA is by and large maintaining input floors that generally align with the underlying BCBS standards, the Basel standards. There are still a couple of notable exceptions. So you mentioned gold plating. I think one of the last outstanding examples of the PRA gold plating those standards is the fact that they're still going to apply that more conservative probability of default floor of 0.1% for UK resi mortgages. But, likewise, when it comes to LGD, loss given default, the final rules, they're generally consistent with the Basel standards. There's generally not too much variation between consultation and near final policy. Just quickly, I wanted to touch on probability of default. I mentioned the fact that I wanted to give a positive and a negative in terms of the proposals. And so talked about the model's approval process and how that would be good for challenger firms, but also actually for major firms. But just to counterbalance that point, just to highlight something that's changing that firms may be less pleased to see, which is around model inputs when calculating probability of default. And so here, in alignment with the underlying Basel standards, what the PRA did in the near final, the PS9 24, I think it was, that came out, they confirmed several changes to model parameter estimation requirements for probability of default. And this is a good example of part of that overarching intention they have to try and reduce the variability of RWAs in models and across the models space. And one of the most important elements of these proposals here is relating to the PD estimation framework and is around prohibition of use of this qualitative approach, continuous scales in PD modeling. And this approach, it's currently widespread. It's especially widespread in retail models and for things like mortgage modeling. But this type of modeling approach for probability of default, it's perceived by the PRA as resulting in lower risk weights. And so what the PRA has done is it's emphasized that it has a specific preference for a different type of approach, which is point in time plus buffer. And what that actually may well do is reduce the risk sensitivity of some of the PD estimates in IRB models, especially for mortgage exposures. And as a consequence, what you might see is that models are going to be requiring users to hold increased capital under the new framework against the same exposures of the current framework. So that's just one example to counterbalance the positive news story about models approval that I gave earlier.
Thank you, Freddie. It looks like there's quite a lot of substance for firms to consider between now and January 26. Now, there's quite a bit of interaction between the IRB proposals and the output floor, which we'll turn to next. In India, not much changing from the consultation stage in this area. What has jumped out from the near final rules for you?
That's right to say, not much change. The final rules are quite similar to consultation. As before, the in-scope firms are required to calculate RWAs as they hire off the total RWAs, using their approved internal models, and 72.5% of the RWAs using just the standardized approach. But there is now a shorter implementation period, which is now 4 years. This is significantly different to the EU, where the transition period is 8 years. The PRA has also made a change to clarify its stance on accounting provisions in the context of output flow computation. And it's also worth noting that the PRA has not made any changes to address firms' feedback on the treatment of securitization exposures and significant risk transfer. This is because these topics are being dealt with separately as a part of a separate discussion and consultation.
Thank you for that, India. That brings to a close a summary of the near final rules on credit risk and the output floor. I hope everyone watching found that useful and informative. We have a few minutes to run through a quick Q&A session. If you have any questions you want to ask, please include them in the chat or the Q&A box, and we'll try to answer as many as possible. If we don't get to your question, we'll try to follow up with you after the webinar. So we have one question. The SME adjustment, is that proposed in the interim period or ongoing? How long will the SME adjustment be relevant for? Freddie.
So my understanding is that, and there isn't that much detail around this at the moment, but my understanding is that adjustment is going to be ongoing on a permanent basis. But it's something that the PRA is going to need to provide more information about. And so it's not just going to be something that's going to follow through some sort of interim period. It's going to be a fixed adjustment that's going to be part of the framework. Actually, it's a little bit ironic because India and I were doing a session on SDDT last Thursday. And so to give an example of what that adjustment might look like, you've got this idea of a refined approach for smaller firms where, because they're perceived to be overcapitalized under the standardized framework at the moment versus IRB, they're allowed to apply a capital offset in Pillar 2A. That is actually being removed as part of the SDDT regime implementation, but something like that could actually then come into existence as part of the sort of Basel 3.1 standards in the UK. And the same is true for infrastructure supporting factor. And I'm just checking my notes because I'm fairly sure the same may be true as well for some IRB firms. There's also potentially going to be a Pillar 2A adjustment related to the fact that quasi-sovereigns are now going to be excluded from the IRB framework. So I think it's going to stay. It's going to be a feature of the regime going forward.
Thank you for that, Freddie. Another question in India, maybe one for you. The valuation changes, what exposure classes will they impact? Anything other than mortgages?
So your so your AVMs are largely for real estate valuations. So, you can use your AVMs to value your residential and your commercial real estates. In terms of how else it's going to impact, it's mainly going to be around the risk weights. So you've as we said, there is a redefinition in terms of the risk weights that would apply to exposures that have between 60 and 80% LTV, and therefore it is important to specifically focus on those areas, because that's where things have changed since consultation. But with regard to these valuations, it focuses mainly on property, mainly on mortgaged exposures, and that's where firms should focus the most on.
Thank you for that, India. And sometimes we also get asked how near final are these near final rules and whether things can change again. I think our view is we don't expect the proposal to change after this for Pillar 1. But clearly, there are a number of things that have been pushed into Pillar 2A. So we'll have to see how the PRA approaches the implementation of Pillar 2A changes in the near future. Just checking if we have any more questions
I
here
think
in the
just
chat.
to add to that as well, Hussein, there's been some chatter about, in terms of the finality of these rules, would the PRA respond, for example, to any changes internationally? Because you would have seen in the near final rules a greater focus on that kind of idea of competitiveness compared to the consultation paper. But I think given that the PRA has already given a fair amount of ground, and given that they basically left the door ajar to structural adjustments in Pillar 2A, as you said, it doesn't seem that likely that there will be major rejigs to the Pillar 1.
We have a detailed question here, which we'll see if any of us on the panel can answer. What is the line defining residential property to commercial property for holiday accommodation versus holiday lets?
That's
a very specific question.
No. That is a good one, and that is actually a very good question, because it's not that easy. So the question here is, if you have a buy-to-let property, and it's a holiday let, and the bank repossesses it, could it be sold as a standard residential? And if you look at most holiday lets right now, fairly self-contained accommodation, and like it would satisfy all the definitions under the Housing Act. So it could be very easily be resold as a residential let. So which is not the case if you look at how care homes are designed, or indeed how purpose-built student accommodations are designed. But the holiday lets and your and your residential homes, they're quite similar in terms of build and use, perhaps on either side of the bank's repossession. So I do accept that there is perhaps a thinner line there than there exists for the other types of accommodation that has been specified. With regard to determining whether something is commercial or residential, you've got to look at that there are a number of metrics that you can look at. Firstly, look at what sort of mortgage it's under. Is it buy to let? Is it capital repayment? To what extent can perhaps a downgrade in the rental market or the property value has impacted repayments from that particular landlord across all their mortgage properties in the past. So there aren't any specific rules specified under the PRA new rules on this judgment, but quite reasonably there are a number of things, quite a number of reasonable metrics that individual firms with idiosyncratic exposures could look at and build up to convince their CRO that it remains appropriate. And as the PRA has always said, in such areas where firms are exercising judgment, if the firm is able to convince the PRA that they're okay with it, the PRA should be okay with it. So that's what I'm going to encourage firms to focus on, is to come up with a suitable metric and appetite that would help them demarcate that line, and be in a position to explain that to the PRA and do so robustly.
Thank you for that, India. Thank you for joining us today, and thank you to India and Freddie for their insights. I hope we've been able to summarize the key elements of the near final rules and share some of our insights in the 30 minutes we had this morning. We'll provide the feedback form in our follow-up email, so please let us know any feedback from today's session. We'll be holding another webinar next week on the 2nd of October, focused on the operational aspects of the regime, including how firms should think about implementing Basel 3.1 and some of the possible implications for regulatory reporting and disclosures. For firms considering SDDT, please also watch our webinar from last week. Links are available from the Forbes Mazars website and our LinkedIn page. Finally, please also complete our regulatory reporting survey from the QR code that was on the introductory screen. Look forward to joining you at our next webinar session. Have a good day.